All right, and we're also seeing a healthy U.S. economy. No signs of recession, but we're looking at the U.S. yield curve inverting further. We're just a couple of basis points out from the lows that we had in March. What does this reading tell you, the yield curve?
It's just purely a reaction function to what we're hearing from the Fed. So the expectations, if you can recall, in the ancient days of 3 months ago, when you remember people were pricing in 2 cuts before year end, all of a sudden those cuts have not only disappeared, but the market is beginning to come to the realization that they're going to have to take the Fed at its word. So potentially 2 more hikes this year. The market still hasn't even fully priced in those 2 hikes. You see one almost certainly priced in at about an 85% likelihood in the month of July. Then there's some question as to whether there's one more hike this year. It's about 50-50 right now as it's priced in the markets for sometime around September-November Fed meeting. We expect that it's likely going to be at least one rate increase, probably closer to 2 at this point. And when we actually look out a little bit further, what we were originally anticipating a recession towards the end of 2023 has now been pushed very far off. We're actually looking much closer to the end of 2024 now for U.S. recession.
Let's talk now about the markets as we wrap up the first half of the year. We're already at the 30th of June, and we've seen the NASDAQ rise some impressive 29% year to date, this being the biggest gain for that benchmark in about 40 years. What is your outlook for the markets in the second half?
No question, the NASDAQ tech names, especially the mega cap tech names in the U.S., have gotten far ahead of themselves as far as current market valuations. When you strip those out and you look at the underlying data of the other companies, even in the S&P 500, you see that there is significant value to be gained. Most, I would say 90% of the companies in the S&P 500 have not outperformed the broad S&P benchmark this year. So there's tremendous value still existing within the S&P 500. We're tending to look outside of there for better value right now. We think the U.S. mid-cap space, it offers very compelling valuations and an opportunity if you do avert a recession or should it get pushed further out. You should see a strong rebound, we think, in small and mid-cap companies in the U.S. Beyond that, as you go outside the borders of the U.S., there are opportunities emerging Asia, emerging Latin America. Again, valuations look very compelling. And if you want to get even more niche, you can look into European energy companies. Starting to be some really compelling valuations in energy names as markets have started to price in much lower energy prices. But the valuation discount between European energy names and U.S. energy names is at the greatest levels that they've been in quite a while. So we're looking for those opportunities right now to be able to deploy cash. We want to be equal weight on our equity exposure. We're not looking to go underweight, but we recognize that the risks are increasing in a small number of names in the tech sector, specifically in the U.S.